Have you heard of the term FCCB, Foreign Currency Convertible Bonds? If not, then you must watch this video. I'm a learning partner, Sushila Hariharan, and if you're interested in a career in global financial markets, including investment banking, operations, trade life cycle, OTC derivatives, and hedge funds, do subscribe to my YouTube channel where we provide content-centric videos on these topics. So, a foreign currency bond is a bond that is issued by a company in a currency that is not the home currency of the issuer. This sounds fairly simple, right? You have domestic bonds, that is, bonds that are issued by companies in the same currency in which they are having their operations. And then you have foreign currency bonds. So a domestic bond is a bond which is issued in the same currency, like a USD bond issued by an American company and traded in the US markets. Is a domestic bond for the US investors, and these are sometimes called as Yankee bonds. In the Tokyo markets, in the Japanese markets, you have samurai bonds. These are bonds that are issued by Japanese corporations denominated in JPY. So this is fairly simplistic in understanding the concept of a domestic bond. And what is a foreign currency bond? A foreign currency bond is a bond that is issued by a company in a currency that is not the home currency, like an Indian company which is issuing bonds in USD in the US markets. So why does an Indian company issue dollar denominated bonds in the US markets? The reasons could be many, but the main reason is that there could be interest rate advantages in terms of sheer cost of capital, because historically the USD interest rates was far more significantly lower than the INR interest rates. Of course, in the last 3 years, that advantage is no longer there in terms of the enormity of the spread between the USD interest rates and the INR interest rates. So then why do they want to issue bonds in USD if they're also going to be running the foreign exchange risk? Because when you issue bonds in a foreign currency, you'll obviously be having conversion risk, especially for coupon payments as well as for payments at the time of redemption. The second main reason that many Indian companies approach the dollar bond markets, is because they have operations in USA. And when they have operations of large scale, you can consider many companies in India today who are having significant number of factory setups, manufacturing, warehousing, distribution, etc. in the United States. Then you find that you're earning in dollars, and therefore a smarter way to raise capital for funding these activities would be to raise dollar denominated capital. So many Indian companies are drawn towards issuing bonds in the dollar market to fund and finance transactions, acquisitions, or even mergers, especially in the United States market. In the last few months, when the JPY interest rates were also significantly lower, many Indian corporates also raised capital in the Tokyo markets because the interest rate advantage was significantly high. But remember this, a foreign currency bond is only useful as long as there is a foreign exchange stability. Because if there is too much of foreign exchange volatility, then every coupon payment for the issuer will become even more expensive than the previous one, and the redemption, which could be 5 years, 6 years down the line, could also turn out to be quite expensive. So hence many companies have to account into consideration the differences in the foreign exchange risk as well as the interest rate risk. So foreign currency bonds thus have gained popularity amongst corporates in India who have financially savvy dealing rooms and financially savvy CFOs, because they want to take advantage of the interest rate differentials as long as that there is foreign exchange stability in the currency pair, that is INR versus whichever currency that they are issuing the bonds at. The second part of this term, foreign currency convertible bond. Convertibility means the bond can be converted into equity. So there is foreign currency, and then the bond gets converted into equity. The conversion of equity, the conversion of bonds into equity is sometime in the future, but the swap ratio is typically predetermined, and if the investor finds it is favorable for them, then they go ahead and go for the conversion. So foreign currency convertible bonds, which were a rage in the early part of 2011-2012, because INR interest rates were quite high compared to USD interest rates, and the conversion also made tremendous sense for the investors, is now not so much in favor with the investors, both domestically as well as in international markets. So there is not so much of demand for such kind of bonds, then naturally the issuer will not be in a position to issue bonds because there will be no undertaking for the same. Thank you so much for watching in.